Bank charge. The term bank charge covers all charges and fees made by a bank to their customers. In common parlance, the term often relates to charges in respect of personal current accounts or checking account. These charges may take many forms, including: much of the following discussion relates to the UK personal current account market. Monthly account charges. Banks may charge their customers a fixed monthly charge for the provision of the account. In the UK, this was not common practice until the 1990s, when banks began to introduce this type of bank charges as a means of product differentiation, often offering additional services bundled with the bank account itself, for example travel insurance, mobile phone insurance, preferential rates on other products. Charges for specific transactions. Until the 1980s, most banks in the UK charged for all transactions. A number of newer entrants to the personal current account market took a no-fees whilst in credit approach, leading very rapidly to a situation where no bank could compete with others without offering the same deal. While the loss of income incurred was, to some extent, covered by the interest earned on carrying balances in current accounts, the bank's profitability on personal current accounts was severely impacted by this change in the charging structure. In turn, this led to the bank's increased use of charges for exceeding overdraft limits as a means of generating their required level of profitability. Interest in respect of overdrafts. Most banks charge interest to their customers in respect of overdrafts. It is common to charge differentially for authorized and unauthorized overdrafts, with unauthorized overdrafts often bearing an interest rate 2 or 3 times higher than authorized ones. In order to gain customers from competitors, banks will sometimes offer introductory 0% or low interest rates on authorized overdrafts, together with generous initial overdraft limits. As part of the development of the personal current account market in the UK, certain banks have altered their overdraft charging structure to a fixed daily charge, irrespective of the size of the overdrawn balance. Charges for exceeding authorized overdraft limits. As banks' income from transaction charges declined, due to the free banking that had become the de facto standard in the UK personal current account market, and the bank's income from carrying balances fell due to declining interest rates, banks sought to increase the profitability of their businesses by significantly increasing the charges levied for exceeding authorized overdraft limits, or when customers make payments, or attempt to make payments, including direct debits, check payments or standing orders, where no authorized overdraft limit exists. Typically, banks charged in the region of £25 to £39 for transactions in breach of an authorized overdraft limit, irrespective of the size of the transaction or the degree by which the limit was exceeded. These charges are commonly referred to as penalty charges, although penalty charges are explicitly forbidden under the law. Many individuals were able to retrieve money paid in such fees through the magistrates' courts on these grounds. However, this has since been halted by the decision in the case OFT v. Abbey. The High Court and Court of Appeal rules that these charges were not penal in nature, and the Supreme Court further ruled that they cannot be regulated by the Office of Fair Trading. In August 2014, Oliver Foster Burnell obtained judgment against Lloyds Bank plc for unfair terms leading to bank charges. Transfer redirection charges. A redirection of transfer charge is included in bank charges and are only required on specific transfer occasions only. A redirection fee is a bank charge that is only paid to a bank when a mistake is made by another bank and a sum of amount is transferred into a wrong bank account in another bank. This may occur between continents, countries or states. A redirection fee is often expensive when required, as the bank requiring this may not have legal rights to freeze the account the funds are mistakenly transferred into. It may also require urgent attention depending on the banking rules of the country, and it takes a period of 30 to 45 minutes for a redirected transfer to be completed. This is normally caused in a bank wire transfer, telegraphic transfer also known as telex transfer, TT, and most times, local bank-to-bank transfer. A redirection fee is only needed to be paid to the bank the funds are in, and the bank will have to redirect the transfer to its correct destination. Most banks calculate this type of bank charge according to the amount in question. A redirection of transfer charge is very important subject for the all banks. This is play vital role during the transfer. These charges are applied by the all types of banks. There is also include nationalized bank,